For more on the earnings, let's turn to Alex Young. He's equity market strategist at Standard & Poor's to recap this week's batch of reports and really for some perspective on the 7% run-up in the S&P 500 in the past week. He comes to us from his firm's offices right here in Manhattan. Alec, good to have you back on Bloomberg. Good afternoon.
Nice to be with you.
So, your take on earnings so far. We're very early in, but what do you think so far?
Yeah, I mean, a lot of this has to do with the expectations game, and I think in general, there's been a lot of caution, a lot of concerns about a correction in the market over the last couple of months. So people's expectations were very low, and I think that really played into corporate America's hands. They were able to pull out the old cost cutting to kind of exceed some low expectations. I know it's early in the season, but I think that trend is going to have some legs as we move through. But as always, there's a tremendous amount of focus on guidance, and I think by the third quarter, S&P, as well as the consensus, is looking for a move to basically flat year-over-year earnings. By the fourth quarter, earnings are expected to be up very strong. So I think it's going to be critical that when we hear guidance here, we need to start hearing about some stability in the top line, because you really can't cut costs forever. If earnings are going to do anywhere near what people expect them to do in the second half, we're really going to need to see the top line get shored up.
Hey, are the fundamentals out there, though, the economic fundamentals out there, though, to support top-line growth, revenue growth? Maybe not this quarter, maybe not next, but by fourth quarter, will they be out there?
Yeah, I mean, I think that's the biggest argument the Bears have. When you look around, even though things are less bad, it really doesn't feel like it. But I think the reason the Bears have been wrong for most of the last few months is I think the market priced that in when it melted down, that we were in a tough revenue environment. At this point, most people believe that we are in recovery. It's going to be gradual. It's going to take a long time. But I think the less bad is good enough. One area that we're focusing on in terms of the second half is S&P 500 foreign sales. They are currently, for 2008, the latest year where we have data, they're about 48%. So the S&P has more and more leverage to a weak dollar because almost half its revenues are now coming from overseas. At S&P equity, we expect the dollar to weaken in the second half, and we think given how high the bar is set, especially in the fourth quarter, corporate America is going to need all the help it can get, and it may just get some for currency. That's more of an earnings driver, not a revenue driver. But ultimately, what investors care about is earnings per share. So technology and energy are the sectors that both have the highest amount of sales coming from abroad and would benefit the most if the euro, the yen, sterling, the Canadian dollar, if those guys were to appreciate a little bit against the dollar in the second half. And we think that that'll happen.
And Alec, what you're talking about, when you've got a weaker dollar, when you translate those profits from overseas back into dollars, there are a lot more dollars, correct?
Yeah, it's really a free lunch. If you have, let's say you're a company and you have $1 billion of European sales, and the euro goes up 5% against the dollar, that $1 billion of revenue just got 5% more profitable for you if you're an American company, repatriating those stronger euros and converting them into dollars.
All right. So then you're comfortable with this 7% move up on these earnings?
Yeah, given the whole macro picture, how much bad news was priced in during the meltdown of 2008 in the first quarter, yeah, we think the market will continue to kind of grind higher in the second half. We don't think you're going to see the gains that we've seen since March, but we're certainly not big bears here.
You're not big bears. Okay. No. All right. So only 61 companies reporting so far. Just give me an idea of what you're going to be watching very closely next week, Alec.
Yeah, we're going to want to see, in terms of, it's really more about the guidance. Everyone knows this quarter is going to be lousy. But on the guidance, you know, obviously, companies don't have a lot of visibility, but we want to see that, okay, third quarter, you're expected to be roughly flat year over year. You know, hopefully you get a little bit more contribution from revenues, and it's not just about cost cutting. The other thing we've noticed is this quarter, the defensive, staples, healthcare, utilities holding up better. You'd expect that. But you know, will we see some more oomph from the cyclicals as we move forward?
Got it. Alec, thank you so much. Enjoy your weekend.
Sure, you too.